Ready to 10x $100? It sounds like a fantasy, but what if I told you there's a structured, repeatable roadmap to turn that single Benjamin Franklin into a grand? This isn't about lottery tickets or blind luck. This is a system, a high-octane, disciplined strategy designed for one specific purpose: to aggressively grow a small account. Forget the slow and steady advice you hear for large portfolios. When you're starting with $100, the rules are different. You need a plan that embraces calculated risk, demands precision, and rewards flawless execution. This is that plan. We're going to break down the exact allocation, the types of opportunities to hunt, the entry signals to look for, and the strict rules for taking profit and managing risk. This is your roadmap from 100 to 1000. No fluff, just the blueprint. Let's get into it. Step 1 is the foundation of this entire strategy: allocation. Before you even think about what to buy, you must decide how to deploy your capital. We use the 70-20-10 rule. This isn't arbitrary, it's a carefully balanced structure of offense, flexibility, and defense. First, 70% or $70 is allocated to your main trade position. This is your primary offensive weapon. With a small account, you can't afford to be timid. This 70% is for your highest conviction, highest upside idea. It's where you'll be aggressive, aiming for that significant multiplier that propels your account forward. This is the engine of your growth. Next, 20% or $20 is reserved for a backup trade plan. Think of this as your flexible reserve. The market is dynamic. Your primary setup might not trigger, or another equally compelling opportunity might appear unexpectedly. This 20% allows you to pivot or take a second shot without having to liquidate your main position or sit on the sidelines. It prevents you from putting all your eggs in one basket, giving you a second chance to find a winner. Finally, and most critically, 10% or $10 is held as a stop-loss safety cushion. This is your ultimate defense. This $10 is non-negotiable. It is the capital that ensures you survive to trade another day, even if both your main and backup trades go completely to zero. It's the firewall that protects you from total ruin. Protecting this 10% is your number one job. It's the key to longevity. Step 2, finding a high-upside short-term opportunity. With our capital allocated, we now become hunters. We are not looking for safe, slow-moving blue-chip stocks. We are searching for volatility and explosive potential. We need assets that can realistically move 3x, 5x, or more in a relatively short time frame. This means focusing on specific types of assets. First, trending stocks, particularly in the small cap or mid cap space. These are companies that are already showing strong upward momentum, often driven by a powerful narrative or sector-wide tailwinds. We're looking for a clear upcoming catalyst, like an earnings report that's expected to beat estimates, a new product launch, or a pending FDA approval. The catalyst is the event that can turn momentum into an explosive breakout. Second, you can look at leveraged ETFs. These instruments are designed to amplify the daily returns of an underlying index, like the Nasdaq, or a specific sector like semiconductors. If you have high conviction that a sector is about to have a strong week, a 2x or 3x leveraged ETF can provide the amplified return we're looking for. But be warned, they also amplify losses, so precision is key. Third, we have crypto coins, specifically altcoins with strong on-chain metrics. We're looking for coins with growing daily active users, increasing transaction volume, and a clear narrative or upcoming protocol upgrade. These on-chain catalysts are transparent and can signal a groundswell of interest before it's fully reflected in the price. The key across all these asset classes is the combination of existing momentum and a forward-looking catalyst. Momentum gets you to the party. The catalyst is the explosion that gets the party started. Finding the right asset is only half the battle. Now, you need to pinpoint your entry. We don't buy simply because we like the story. We wait for technical confirmation. This is how we avoid jumping in too early or chasing a move that's already over. There are two primary signals we demand before deploying our capital. The first is a clear volume spike. Volume is the fuel of every major price move. A sudden dramatic increase in trading volume tells you that institutional players, or a large number of retail traders, are taking notice. It validates the move. A price increase on low volume is a warning sign. A price increase on a massive volume spike is a green light. It shows conviction in the market. The second signal is a clean breakout above a recent resistance level. Resistance is a price ceiling where sellers have historically stepped in and pushed the price back down. When a stock or coin decisively breaks above this level, especially on high volume, it's a powerful signal. It means the sellers have been exhausted, and the buyers are now in full control. This breakout is our trigger. It's the starting gun for the race. We wait patiently for the setup, for the catalyst to be near, and then we act decisively only when we see the volume spike and the price breakout. This discipline separates professional traders from gamblers. Step 3. Set clear targets and profit rules. This is where most aspiring traders fail. They know when to get in, but they have no idea when to get out. Greed takes over, and they watch their paper profits evaporate. We will not make that mistake. We operate with a predefined, mechanical set of rules. First, for our main trade, we are aiming for a 3x to 5x move. That means, if we enter a trade with our $70 allocation, our primary target is to see that position grow to between $210 and $350. This is our grand slam, but we don't wait for the grand slam to take money off the table. Our second rule is to take partial profits at the 2x target. The moment our $70 position hits $140, we sell half. We immediately cash out $70. This single action is psychologically and financially transformative. You have now recovered your entire initial risk on the trade. The rest of the position is now a free ride. This removes the stress and allows you to manage the rest of the trade from a position of power, not fear. The third rule is executed immediately after taking partials. Move your stop loss to your break-even entry price. Now, it is impossible for you to lose money on this trade. The worst-case scenario is you get stopped out for no gain and no loss, but you've already pocketed your initial investment. This combination of taking partial profits and moving your stop to break-even is the core of professional risk management. It's how you lock in gains and give yourself the chance to capture that massive 3x to 5x winner without taking on undue risk. Step 4. Reinvest gains and scale your capital. This is where the magic of compounding begins. Let's say your first trade was a success. You turned your $70 main position into $210. Your total capital is now your original $100 plus the $140 profit for a new total of $240. Now what? You don't withdraw the money. You don't go on a shopping spree. You roll those profits aggressively into the next trade. Your system remains the same, but your numbers get bigger. You apply the 70-20-10 rule to your new capital base of $240. Your new main trade position is now 70% of $240, which is $168. Your backup trade is 20% or $48, and your safety cushion, the most important part, is now 10% or $24. Notice how everything is scaled up. Your potential profits are now significantly larger because your position size is larger. A 3x move on a $168 position is over $500. This is how you climb the ladder from $100 to $1,000. It's not one lucky trade, it's a series of well-executed trades where the profits from one fuel the next. But there is one rule that never changes. You always keep that 10% safety cushion intact. As your account grows, that cushion grows with it, providing an ever larger buffer against disaster. This disciplined process of reinvesting and scaling is the engine of wealth creation. Finally, let's talk about the glue that holds this entire system together. Discipline. You can have the perfect strategy, but without discipline, you have nothing. The market is designed to exploit your emotions, your greed, your fear, your impatience. Discipline is your shield. First, you must trust your rules over market hype. There will always be a new, shiny object, a stock everyone is screaming about. If it doesn't fit your strict criteria for momentum, catalyst, and technical confirmation, you ignore it. Stick to your rules. Always. Second, you must cut losers fast and without emotion. Not every trade will be a winner. In fact, you will have losing trades. The key is to keep them small. If a trade moves against you and hits your predetermined stop loss, you exit immediately. No hesitation, no hoping it will turn around. You cut the loser quickly and preserve your capital for the next opportunity. A small loss is just the cost of doing business. A large loss can end your career. Third, you must let your winners run. This is the flip side of cutting losers. After you've taken partial profits and moved your stop to break even, you have to give the trade room to work. Don't get scared out of a winning position by a small pullback. Use a trailing stop to protect your gains as the price moves higher, but give it space to achieve that 3x or 5x target. Cutting losers fast and letting winners run is the fundamental secret to profitable trading. So, let's recap the system. You start with $100. You allocate it 70, 20, 10. You hunt for high momentum assets with a clear upcoming catalyst. You wait for the technical confirmation of a volume spike and a breakout. You enter with a clear plan. Take partials at 2x, move your stop to break even, and aim for a 3x to 5x winner. You cut your losers without mercy and let your winners ride. When a trade is complete, you roll your profits into the next one, scaling your position size as your capital grows. You repeat this system with unwavering discipline. This is not a guarantee. Trading involves substantial risk, and you can lose your entire investment. This is a high-performance framework that requires skill, practice, and emotional control. But if you can master the system and execute with precision, you have a realistic path from $100 to $1,000. You have the roadmap. Now, it's time to execute.